All right, guys, welcome to another monthly portfolio update. This is number 16. It is August of 2025. And yeah, I'm recording a little bit later than I'm used to doing, but man, I made a ton of changes in the portfolio. Vacation was good to me, opened up my thoughts and made me think about lots of different things. And today we're going to go over all of the changes that I made. So last month, the portfolio was sitting at $385,000. And I'm blown away. We broke the $400,000 mark. Now, I am recording, like I said, on September the 4th today, so I'm a few days past the end of the month when I would normally do this. So I'm going to be totally transparent here. Today, it's $401,000, but on the 31st, we were sitting at about $397,000. So things have changed. The markets took a little bit of a dip, and now they've kind of picked back up. Pretty normal, but I'm just so pleased that I broke that. And now let's get into all the changes that happened this month. Now, for you guys that are new here, my name is Darren. I'm just a regular Canadian sharing my investing journey. I used to think that it was way too late to start investing, but I started at 50 and I'm proving every single day that it's never too late to build wealth. All right, so let's jump right into everything and we're gonna go over everything from A to Z. But to give you guys some perspective, I started my investing journey in April of 2023 with just over about $200,000. And I had no experience, had no idea what I was doing, and I realized that I missed out on so much. Now I've grown this portfolio from that point of about $200,000 plus to where it sits today. Now, full disclosure, of course, that is not all growth. There's no free lunch when it comes to investing, and I've gone through lots of strategy changes over time. The key here was to do a lot of simple things, clear up my debt, make sure we're making regular contributions, and picking a broker that works best to save on some fees. Those are some pretty basic things. And since then, we've been making regular contributions every single paycheck to get us there. Now, something important to know is that I'm still in my accumulation phase. So I'm 52 today, and I'm going to retire in about 8 years. Now, some of you that might be watching me are a little bit older, maybe you're closer to retirement, and so some of the things that I go over with the funds that I'm using may be more applicable to you or some of the strategy ideas that I put out there. But remember one thing, I'm not a professional, I'm just a regular Canadian who's sharing my journey. So you have to do your own research, you have to get to know what works best for you and your strategy. The net contributions to the account during the month of August were $5,243. Now, why is this important? It's important because, as I told you, I'm in the accumulation phase. Some people at my age, I'm 52, they may actually be retired or very close to it. And for you, the accumulation phase may have already ended. Although, one thing that I learned is even though I was starting at 50, a lot of people, they actually work till they're 60 or 65 years old. All of that time is accumulation phase. And during that accumulation phase, that compounding really works for you. And that's why I like to show the numbers. So if you go back and look at each month that I've been posting how the portfolio performs, you're going to see that growth in the account that comes from compounding. It's not just from the contributions. Now, one thing that you guys really like to see is the amount of dividends or distributions that the portfolio is making. In my case, it's averaging just over $1,000 a month. Some are greater than others, but that seems to be a big driver for a lot of people to see. But here's the thing, my portfolio is split. So last month, I talked about having about 20% of the portfolio income oriented, and that was largely due to the fact that my wife is facing some medical issues and she may not be able to work. And if she's not able to work, we need to be able to supplement that income. Well, we've come full circle. I've crunched the numbers and I know now what we need to produce because she does have some disability money that could come to her should she go off. Fortunately, she's not there yet. And so some of the changes that I made this month with respect to income might actually change. So 80% of the portfolio is strictly focused on growth. And I'll go over some of the bigger positions so that you can see which ones those are. So for some of you that are a little bit older or you're looking for that income, this portfolio is certainly not generating, hundreds of thousands or thousands of dollars every single month. What I'm still trying to do is grow the portfolio in that sort of compounding through natural growth in growth ETFs rather than just having certain monthly distributions. All right, guys, so you can see the portfolio sitting at $401,000. And as far as a target goes, I set a target of $500,000 before I retire, which is in about 8 years. And you can see here that we're 80% of the way there. Now, the reason that we can see all these metrics is because we're using a tool called Passive. We're also going to use another one that's called Wealthica. I have links in the description for both of those. And if you're looking for a free way to support the channel, you can use the links because I do get a small kickback when you use them, especially if you look at the paid versions, although the free versions are completely great for any of you that are starting out. So let's look at a global look at the portfolio at this point. So I have lots of different accounts that I manage. They're my wife's accounts and my accounts. And then I do have one for my kids because we're teaching our kids this stuff because we want them to learn them. So the big one at the top here is our spousal RRSP. So that's where I make the contribution. My wife gets the benefit of taking that money out and I get the tax credit right now. That account's sitting at $117,000. Now, up to the last monthly update, I was funding this account with funds that we were putting into our mortgage that were extra mortgage payments that I got some financial advice through work, through a financial advisory company called Enriched Academy. And the advice was to actually take that money and put it into a RRSP for the tax benefits and the growth. Because at the end of the day, investing is all about math. What makes the most sense? You're never going to become a millionaire. And when I say that, I mean there's no free lunch when it comes to investing. So you have to use a little bit of math to figure out what makes the most sense. So by putting more money into the mortgage, I would definitely be able to pay it off faster, but our interest rate is far less than what I can earn on that money if I'm actually putting it into an RRSP. Now, that might not work for all of you, of course, and it's certainly not advice, it's just what I'm doing, but it makes the most sense for me. And if you're not sure, reach out to a financial advisor and check it out. And like I said, the one that I used is Enriched Academy, but there are plenty of other ones that are out there. So right now, that account was being funded up until this month. But if you know from watching previous videos, we had to replace our heat pump and our furnace. And one thing that's important, and I talk about it all the time, is you should always have some sort of emergency fund. You know, the basic recommendation is about 3 to 6 months of money to set aside in the event that you were to lose your job or something like that. Or in our case, like this, our air conditioner kicked the bucket and so did our furnace and we had to replace them. But it ate up every bit of our emergency fund. So we've had to build that back up. So if we scroll down to the bottom here, we're gonna see the emergency fund here. So what I did is my wife's TFSA is not being used, and there's a lot of like psychological pieces to investing as well, especially for me. If I see money sitting in a certain place, I might be tempted to do something with it. So what I did is I set it up in my wife's TFSA that it'll be completely separate from everything else. It's its own account right now, and I titled it emergency fund so I know exactly what that money is for. Now, typically in the past, if you've been watching me or if you have an emergency fund, some of the suggestions are keep that money set aside and maybe you put it into a high interest GIC or maybe you put it in a high interest account. For me, I want it to be liquid that I can use it right away, but I also didn't really like the interest rate that I was seeing on some of the accounts that I had it in. So I made a small change. For me, our emergency fund sat around $20,000. You go back, watch some of the earlier videos, you'll see that. I want to build it back up, but I also want that money to earn interest or to earn more than I think it can, but still be liquid. So what I decided is to use that TFSA. Your TFSA is such a powerful tool when it comes to investing. A lot of people think it's just a place to save money. In fact, I've had some conversations at work with colleagues that are older than me that still think that. The fact is, this is a great tool to invest with, and your money can be liquid because with Wealthsimple, which is the broker that I use, you can actually sell your positions and remove your money and use it almost instantaneously. So what I did is set that account up. Now, I'm going to show you in a bit what I've done with the money within the account to help it grow a little bit faster. All right, so back up to the top. We have the kids' TFSA, not much in it, about $2,800. Again, it's just a tool for the kids to learn. It is my wife's TFSA, but at the end of the day, it's a tool we're using for them. And you can see I've labeled it separate account. And just so we're clear, I have two brokers. I use Wealthsimple primarily, but I also use Questrade. The reason that I use Questrade is because I can use Norbert Gambit to convert Canadian funds to US and invest in US dollars. So this whole portfolio is split almost down the middle, about 50% in USD and 50% in Canadian funds. And that's designed to allow money to grow when each dollar might be stronger than the other. And typically the American dollar is a bit stronger. Do I pay fees to convert back and and forth, yes, but with Norbert Gambit, those fees are greatly reduced, say against some other place like Wealthsimple, for instance, that might charge 1.5% on every transaction. All right, so the other one is my wife's RRSP. No contributions going in there, about $62,000 in there. And a lot of these accounts, guys, they're all set up very similarly with the funds that I have, and I'll go over what that looks like in a minute. But I've structured them essentially similarly so that they have similar positions in them. And then we have my TFSA. Of course, the TFSA is the reason I started the channel. I wanted to build it from zero to maxing it out. I wanted to show people that it can be done and how you can go about it. Now, the contributions that I make, yeah, they may be more than you can, but at the end of the day, you're making your money work for you when you use your TFSA. The other thing to remember is that TFSA is after tax dollars. You're not deferring tax here like the RRSP. You're making your money grow now, and you can use it whenever you want. And if you're older like I am, which I think a lot of my viewers are, think about it this way. You probably have the max amount of room. So for me, it was over $100,000. So I can just keep plowing money into this thing, unlike young folks who can max out, say, the $7,000 they're allowed annually. And then, of course, that might change every year. So if you're older like me, use your TFSA. It is a great vehicle, and it allows you to make your money grow tax-free. Then we have my RRSP. It's very small. It has grown from when I initially started investing in that one as well. I did put a little bit of money in the beginning, but I realized that the TFSA is way more valuable, so don't put any money in there right now. And of course, any dividends that are coming back in the accounts I'm not funding, I go ahead and reinvest that back into certain positions that exist within the account, and I decide what those are. I used to have drip set up, but I decided to change that where I get to decide where the money goes. All right, so then we have the Wealthsimple spousal account. Now, I started a case study on covered calls. Covered calls have been getting all kinds of attention on Blossom. Yep, Blossom Social. So this would be a good time to talk about Blossom Social. So if you're new to my channel, a lot of my viewers and a lot of people use Blossom Social. What is it? It's a social investing app. Think of it like a place where you can talk all about investing, whether you want to talk about dividends or covered calls or growth investing or single stock positions. This is the place to do it. And it's actually Canadian based, which is absolutely great. Now, I like to think of it as something that brings the pieces of the puzzle together, because when you guys start out, if you're new watching me, you're probably like I was 2 years ago. You may not have a lot of knowledge, or you're trying to figure things out. The nice thing is Blossom allows you to ask questions. They have a learn section. So it's a great way to build your knowledge as you make your money work. All right, guys, one other thing to mention is I do have a link for Blossom Social. So I don't take sponsorships right now on this channel, and I've really been thinking a lot about whether or not I should or shouldn't. I do get companies reaching out, but one of the issues I have is I don't necessarily want to promote a certain company in the investing space right now, because I don't want my viewers to feel like I'm being influenced by them. Now, full disclosure, I am a stockholder in Blossom Social. It's not a publicly traded company, but I believe in the concept of the business, and so I took a little bit of a risk and I put some money into it. But I do believe in the idea. Now, I do have a link. If you use it, I do get a small $5 kickback, but I think this is a great way to support the channel if you choose to use the app. I am most certainly not saying you need to, but for me, it's really brought things together. And this is a great time for me to tell you guys that I noticed that 80% of you that watch my videos are not actually subscribed. And if you're looking for a free way to support the channel, it actually takes seconds to do it by hitting subscribe. But the most important part is that it actually tells the YouTube algorithm that this content really matters. So if you know somebody else that's older like we are, that wants to get started investing and you don't really know what advice to give them, hit the old subscribe button, and this will likely show up in their feed, or you could even share it with them. But at the end of the day, that subscribe button is a free way to support the channel. All right, so let's talk about the spousal RRSP. So a while ago, I started a case study on covered call ETFs because I was very curious about them. As a new investor, the intrigue of seeing all these dividends or distributions that people were getting really got my attention. And I told you before in this video that there's a huge psychological piece to investing. But the thing is, are those distributions really appropriate for me in my strategy at my point right now? I think the answer is no. The reason I'm still in that accumulation phase, so I'm still funding our account. You saw how much money I've put into this account this month, and I'm going to continue to do that, trying to reach that $500,000 goal. Now, of course, if I reach it sooner than I actually thought I would, then we're going to keep going past that, which still means I'm in that accumulation phase, and I want to use compounding to grow the fund. So this spousal RRSP simply has all covered calls in it. There's 3 of them in there, and we'll talk about them in a minute when I go break that down. But I'm not sure that I'm going to keep them that way. I might actually change this in the future to swap them out to something else. Then we have my wife's RRSP. No money's going into this one. Sits about $117,000. Again, very structured like some of the other accounts. And then finally, what we have is Bitcoin. So I started about 2-3 months ago putting $1 a day into Bitcoin. I wanted to get my foot in the door. So my foot's in the door, and now I got to decide how much I want to put into it. So stay tuned and more portfolio updates. All right, so we're going to go over some of the changes that I made this past month, and there were quite a number of them, and I'll go through each one of them and explain why I made these changes. So in passive, it's great. It goes over your activity day by day, all of the transactions that took place when you link your accounts to it. So the first one we're going to see here is that I sold my split fund, which is EAT.UN. Why did I do that? So again, I'm in an accumulation phase. EAT is a split share fund that pays a very consistent distribution every single month. So it's purely designed for income. And I don't think I'm there yet. I think that I still need to let that compounding work. And this fund is not growing. It does have some growth to it, but not enough. And so I decided that I would sell this off and reinvest it into more of the growth funds that I hold. And I'll show you a global picture of what those growth funds look like. So that was number one. I sold that EAT.UN. The other thing that I sold was I also sold all of my position in TELUS. And ironically, my wife and I had an absolutely terrible experience with TELUS this month. And I'm actually going to do a video on what that was because it relates a lot to how you can better use your money, having savings every month so that you can make some more money available for investing. And unfortunately, TELUS didn't help us very much, and I'll go over what that looks like. But the strategy that we employed in order to save the money is solid. Okay, so I sold off all of the TELUS positions throughout all of my accounts. The other thing is I really don't see TELUS growing like some of the other funds that I have, such as VFV or VU, which is the S&P 500. I'm basically trying to gear the portfolio more towards ETFs at this point. Now, that's not to say that I won't hold a few single stock positions, but this one had to go, so I sold it. And the other thing too is it really wasn't growing very much. It does pay a nice dividend, but at the end of the day, I don't need dividends right now. I really want to see that growth going on. So I sold those positions off. All right, so one position that I held that was an income generating fund is HYLD.U, which is HYLD, but in US funds. Because remember I said the account is split, about 50% USD, 50% in Canadian. Now, these HYLD.U were being held in registered accounts, the RRSPs. And the fact is that I don't need any income generated in those accounts because I'm not drawing down on them, and nor is my wife. The reality is that I believe that it's better to have the income generation coming from my TFSA or my non-registered account, which I don't have a non-registered account. But the point is that why waste good growth room in my RRSP when I can have it in my TFSA where it's after-tax dollars? So I decided to sell off my HYLD, but I didn't sell it all off. I sold some of it off. So that leads me to the next thing. So that's XEI. So I hold XEI. XEI pays a monthly dividend. It is definitely low cost, and it's designed to be a long-term foundational holding for your portfolio. Now, it seeks long-term capital growth by replicating the performance of the S&P TSX Composite High Dividend Index. So what are you getting here? Well, if we go to the holdings, it actually holds, lots of big banks, lots of other Canadian companies. So we got Royal Bank, Toronto Dominion, TC Energy, Suncor Energy, Enbridge, Bank of Montreal, Canadian Natural Resources, and so on and so forth. And TELUS is actually in there as well. So this fund is designed with a little bit of growth, but it basically produces monthly income in an ETF form. Now, I had a huge holding of this in some of my accounts, and the truth is that my holdings in some of these accounts were equal to my S&P 500 positions, which are VFV and VU, and I felt that I'm not seeing the growth. Again, if you hear what I'm saying is, I'm not ready for income yet. I need a little bit. That's why I decided that 20% would be, a good number to hold within the portfolio, but I want 80 to 90% at this point to be in growth. So I sold off a big chunk of XEI to put it into my more growth-oriented funds. So the one that I haven't mentioned is XEQT, that's the all-in-one fund, and then VFV and VU are my strongest positions. They are the biggest. They sit in that 35 to 45% of my portfolio. So by selling XEI, I rolled some of that money into these positions because they are more growth oriented. And again, the companies that are held within XEI are also in some of the other funds that I hold. So I'm not losing anything. What I'm gaining is that growth because I don't need that income right now. So to sum things up, I sold a number of positions that I felt were more focused on income and put them into more funds that are more focused on growth. So the timeline that I see here, guys, is that from now until I retire should be about 8 years. And in that time, I can still see lots of growth. But the truth is that that could go beyond that. I could still be making part-time salary or something like that after I retire, even in another 8 years. So potentially I have at least 10 and maybe 15 years to still grow the portfolio. Now, don't get me wrong here. I'm not trying to become a millionaire, but I'm trying to be the most effective because we do have 2 kids. So a lot of financial planning, which something I need to learn more about, is what you're going to do with that money in the end. The truth is that whatever we have will become our kids. So we want to set our kids up as well. So I want to effectively grow this portfolio now until I need to generate income. And at the point that I need to generate income, we will then flip this portfolio and focus a little bit more on income. So let's talk now about the income funds and what each one that I've added in here to generate some of this income that I'm talking about. All right, so we'll start off with the TFSA because it's the main focus of why I started the channel. So I'm at $75,000. So we got a bit more room to go. Should be somewhere over $100,000 until I max it out. And of course, you don't want to max it out because there are penalties if you put too much money in. So I have an asset allocation set up, which is a nice thing about passive. I tell it what I want for each position, and then when it sees money in the account, so for instance, right now it sees $5, well, that's not enough to buy any shares, so it's not making any recommendations, but if it did, it would make a recommendation on what to buy based on what my asset allocation is. So if we're gonna go over all the positions in the TFSA, which are designed in Canadian dollars, of course, I do have similar ones that are in US dollars in other accounts. So VFV is the S&P 500, XEF and XEC are emerging markets and international markets. Gives me some global diversification. XEI is the dividend income fund that I told you about. Now here's what I've added in as far as income funds go is HHIS. Now, this might be a mistake, and some of you, I'm willing to hear it. So if you want to leave some comments, because you hear me saying that I don't need income, but remember, I'm trying to be prepared for if my wife has to go off. So I said 20% of the portfolio could go into some income funds. Then we have XIC, which is the Canadian market. Another cover call that I introduced was USCL. So that's Global X's S&P 500. We have QQC. So this is the NASDAQ 100. It's a concentrated version of the S&P 500. It's a small portion of the portfolio, about 5%. We have VRE. I wanted some exposure to real estate in Canada. And then we have HYLD, which I've held for a very long time. That is a great income generator. There's no doubt about it. The fund has not really grown a great deal, although there is some growth in it. But of course, with cover calls, you're capping your upside. You're not getting a lot of growth. That's not what it's designed for. It's designed to generate income within your portfolio. So the last one is QQCL. And of course, that's Global X's NASDAQ 100. So what I tried to do was mimic some of the funds that I have as regular ETFs in my income funds, giving myself a bit of diversity so everything's not in one fund if it goes to zero kind of thing, which some people stress about, but I'm not sure that that could actually happen. I suppose it could, but in my little bit of experience, I haven't seen that. And the last one is TSLY, which is Harvest Tesla Income covered call. Very small percentage, 1% of the portfolio. So you can see that I've introduced covered calls that are diverse, but kind of mimic the idea of my growth part of my TFSA. So if we look at my wife's RRSP, we can see it's very similarly structured. Now in a few of these, I do hold XEQT rather than holding all of the individual positions. It just seems a bit easier in some cases if I'm not actually funding it to just reinvest some dividends into that. So I have XEQT in about half the portfolio, and then I have VFV, VU, and all of the other diversified ETFs to make up what is considered XEQT. Because if you look inside XEQT, you're going to see similarities. I just get to choose the weighting of each of those in each account. All right, so let's talk about the emergency fund and what I'm doing with that. So right now it's sitting at $4,561. So this fund is going to be brought up to $10,000, but there's more to it than that. One of the things that people need to remember is you're going to have big bills throughout the year. And some of those bills, some of you may actually put money into, say, your property tax and set it aside with your institution or whatever, but that's my money and I want my money to grow. So what I did is I'm going to actually put the money into this emergency fund, TFSA, and I'm going to slowly build it up over the year so that when that $5,000 bill comes at the end of the year, I'm not scrambling to find the money. But I'm also going to put it in the following fund. So right now we have 100% accuracy, like I said. There's no cash sitting in it right now. The way the fund, this particular part of the portfolio is being funded right now is that $43 that I was investing from the mortgage into the spousal is now going in here to build this up because this is more important. Once this is filled up, we will then start putting money into that spousal again, but I want to get this to the point where it is actually up to that $10,000 mark again so that because then the other 10,000, just so we're clear, sits in our regular banking accounts, and that's to deal with the monthly bills and things like that. So we're going to kind of split it a little bit. So that gives us our $20,000 that we need. And of course, I can adjust this at any time. Those numbers are sort of ones that you decide on your own. So we'll have to get it to that point. So here's what I did. I wanted to do a side-by-side comparison because there's so much discussion on Blossom right now about whether or not the covered call strategy is the best strategy and whether or not growth is the way to go. Well, because I'm so new and I'm still sort of understanding things, and don't get me wrong, I think I have far more knowledge now than I ever did before, and I think I can actually have a rational conversation about some of these things. But the truth is that without you actually trying it, you're never going to know if it actually makes a difference. Now, covered call ETFs are designed for short-term investments. They're definitely not long-term. You can see disclaimers when you go to various providers' websites. And the truth is that they're for income. Now, some of them do generate a little bit of growth, but the fact is you're not going to see growth like you do in some of the other funds like VFV that you can see here. So we're doing a side-by-side comparison. We got 50% of this particular part of the portfolio is in VFV, and 50% will be into 3 different covered calls. Those are HHIS, USCL, and HYLD. And so we're going to test this out. We're going to see what happens because this money is probably going to sit here, for more than a year, and we'll see. Now, I did make one new introduction as a ETF into the portfolio, and I'll tell you what it is and explain why I did it. And what we're going to do is we're going to look into my wife's RRSP because that's where I introduced it, but I'm likely to introduce it into other parts of the portfolio. So in this one, we have VOO. So when you invest in VFV, VFV is the Canadian version. They actually turn around and invest that in VOO. So essentially all the conversion and stuff is being done in the background for you. So the other position I have is, again, we have IEMG, AVUV, AVDV. And by the way, guys, A great place to also do some great learning is the rational reminder. One of the things that I've learned is that you need lots of different viewpoints for investing in order to figure out how it should work properly. So the rational reminder, it's on YouTube. It's also got on Spotify if you want to listen to it. Like I listen to it when I'm driving to work or when I'm out walking the dog. Great way to listen to evidence about investing if you're so inclined to do so. So the other things we have in here is SCHD. It's very similar to XEI in US funds. It tracks some of the big dividend companies in the United States. All right, so here's the big one that I introduced, which is VTI. It is a Vanguard product. Of course, every provider may have their own version of these funds. And of course, there may be, in this case, it's a US listed one. There are Canadian versions of these as well if you don't want to convert your funds. But this one seeks to track the total US market. So with VFV, we're looking at a concentrated version of 500 companies. So if you look at my portfolio, I have broad with VTI of the whole market in the US because there's more than 500 companies. Then I have VFV or VU with 500 companies. And then I have funds that track the NASDAQ 100, which are just 100 companies. I find that, and I've got them weighted so that the greater weighting is obviously to the bigger funds like VFV and VU, where my NASDAQ position is a lot smaller. And I'm doing that to diversify myself a little bit because when one market gains, the other one might not. So it helps balance out my portfolio. And then the last thing that I have in here is VNQ, which is similar to VRE, only it's in US funds and it holds US REITs. So again, giving me some exposure to the real estate market in the United States. So as you guys know, I talked about asset allocation and how that plays a part in my portfolio. And if you want to learn, because you're brand new and you're trying to figure out how to structure your portfolio, I did this video that's popping up here that teaches you a little bit about different kinds of portfolios that you can hold. And of course, they're not the only ones that are out there, but if you want to get started or you're not too sure, you should probably check out these videos right here.